this post up to her article, which I did a video on yesterday. And I wanted to look at some of the responses, because I got to tell you, fans are either on the player's side or they're fed up with all this or all the above. I got to tell you.
Lost amid the heated rhetoric is the fact that ownership's proposal includes several provisions that, on paper, represent substantial improvements over previous agreements. Among them are an offer of 15% of net revenue, up significantly from earlier percentages, along with commitments to enhanced travel arrangements, private hotel accommodations, expanded medical coverage, and full salaries during maternity leave. Supporters of the proposal say those benefits demonstrate a willingness to invest in players' well-being even while the league continues operating at a financial deficit. From their standpoint, the offer reflects a strategy built on gradual growth rather than immediate overhaul. By increasing compensation steadily, owners believe they can reward athletes while still protecting the league's long-term viability. They argue that promising too much too quickly could jeopardize stability if projected revenue increases fail to materialize. In business planning, this approach is often described as scaling responsibly, expanding commitments only when income reliably supports them. Union advocates, however, contend that incremental raises don't adequately reflect the value players bring to the sport, especially during periods of rising visibility. They argue that athletes shouldn't have to wait years to receive compensation they believe is already justified by their performance and drawing power. To them, bold growth requires bold investment, and cautious financial planning can sometimes mask an unwillingness to share profits fairly. The tension between those philosophies, gradualism versus acceleration, defines much of the current impasse. Both sides claim to be acting in the league's best interest, yet they envision different paths to that goal. Owners prioritize stability and predictability, while players emphasize recognition and momentum. Neither objective is inherently unreasonable, but reconciling them requires compromise that has so far proved elusive. As negotiations continue, observers note that public opinion may influence which side feels pressure to adjust. If fans perceive one party as more flexible or pragmatic, that side could gain an advantage in the court of public perception, even before any formal agreement is reached.
I mean, good God. It's crazy. It's crazy. At this point, someone explain this to me like I'm a child. It's the revenue sharing, and that seems to be the biggest holdup, yes? So why not meet in the middle and ask for 18 or 20%? Because at this point, not playing at all isn't profitable for either side. I said yesterday in my video, I think they settle around 17.
One phrase keeps surfacing repeatedly in online discussions: they've got no leverage. Whether that assessment is fair or exaggerated, its repetition shows how widespread the perception has become. Scroll through virtually any conversation about the current collective bargaining talks and you'll encounter similar sentiments. Fans who spent the season cheering for these athletes are now telling them to accept the deal on the table or prepare for a prolonged standoff. That shift in tone is significant because fan backing often acts as informal leverage during labor disputes. When public sympathy fades, negotiating power can erode quickly. At the heart of the controversy is the union's request for roughly 27% of gross revenue. On the surface, supporters argue that percentage mirrors what players receive in the NBA, suggesting it represents parity rather than excess. Critics, however, emphasize a crucial distinction: the financial ecosystems of the two leagues are vastly different. One generates substantial annual profits through massive broadcast deals, global sponsorships, and decades of brand expansion. The other, according to widely cited reports, has historically operated at a loss. That contrast fuels the argument that identical percentages don't necessarily produce equitable outcomes. In business terms, revenue share means little without context about total revenue size, operating costs, and long-term projections. Commentators point out that if a league hasn't consistently turned profits, agreeing to distribute a large slice of gross income could strain its ability to cover expenses, invest in growth, or weather downturns. From this perspective, the dispute isn't simply about fairness but about financial architecture. Supporters of the union counter that athletes are responsible for generating the product audiences pay to watch, so they deserve a larger share regardless of historical balance sheets. Yet skeptics respond that sustainability matters just as much as fairness. If a league promises payouts it cannot realistically maintain, any short-term gain might be followed by long-term instability. That tension between immediate compensation and future viability sits at the center of the debate. What's clear is that the conversation has moved beyond slogans. Fans are now comparing spreadsheets, projections, and economic models, turning what might once have been a niche labor issue into a widely analyzed financial case study.
From 2 Caitlin Clark games. Let's just a big old fat heart right there. Boom. Boom. The players are obviously never going to get 27 plus gross revenue. They should shoot for 18 to 20% realistically. It's not what they want. It's a lot better than what the league is offering. Again, it's going to be net revenue. Jesus, it's crazy.
Look closely at the reactions pouring in across comment sections, forums, and discussion panels, and a striking pattern immediately emerges. A growing portion of fans are no longer merely disagreeing with the players' union, they're openly siding with team ownership in a labor dispute, something that almost never happens in professional sports. In most labor conflicts, public sympathy naturally leans toward athletes, who are perceived as workers challenging wealthy executives. Yet in this case involving the WNBA, the tide appears to be shifting in the opposite direction. That reversal alone signals just how dramatically public perception has changed during these negotiations. Observers say it suggests a serious breakdown in messaging strategy from the union's side, because public opinion rarely flips this sharply unless audiences feel they're missing transparency or realism from one party. What makes the situation even more remarkable is how quickly sentiment appears to have hardened. Early in the negotiations, many supporters were urging compromise from both sides, hoping for a balanced agreement that would reward players while keeping the league financially stable. Now, however, a noticeable share of commentary frames the dispute as a miscalculation by union leadership rather than a routine bargaining standoff. Analysts describe it not as a temporary backlash but as a full-scale public relations crisis that risks reshaping how fans interpret every future statement from the Players Association. The underlying numbers being debated publicly have only intensified scrutiny. Financial projections, revenue splits, and long-term sustainability models, topics once confined to boardrooms, are now circulating widely online. As fans dissect those figures, many say they understand why ownership groups drew a firm line and declined to move further. To them, the refusal looks less like stubbornness and more like a defensive stance against what they view as demands disconnected from current economic realities. That perception, whether accurate or not, has become central to the narrative. In modern sports culture, perception can be as influential as facts, because it shapes which arguments audiences find credible. Once a league's fan base begins interpreting negotiations through a particular lens, reversing that impression becomes extremely difficult. For the players' union, the challenge now isn't just negotiating contract terms, it's convincing supporters that their position is grounded, strategic, and sustainable. Until that happens, every new development risks reinforcing the idea that the public relations battle has already tilted decisively away from them.
This is hilarious. No season unrivaled can set up a 5x5 league instead. And what, start it next year? They're already playing. I mean, come on. Clearly, the offer is offer at this point, sign or
One of the most contentious talking points centers on expansion valuations, particularly the headline-grabbing figure tied to the new Golden State Valkyries franchise. Supporters of the player's position cite the multi-billion-dollar valuation as proof that the league's overall worth is rising dramatically. In their view, such valuations indicate strong investor confidence and therefore justify demands for a larger share of revenue. If investors are willing to pay premium prices to join the league, they argue, that must mean the enterprise is financially promising. Owners and financial analysts respond with a different interpretation. They stress that expansion fees are typically one-time payments rather than recurring income streams. In accounting terms, a lump sum franchise fee can boost a league's balance sheet temporarily but doesn't necessarily reflect ongoing operational profitability. Using those fees as the basis for permanent salary increases, they argue, would be like budgeting household expenses based on a single unexpected windfall. This distinction between recurring and non-recurring revenue has become a central sticking point in negotiations. To the union, expansion valuations symbolize growth potential and market validation. To ownership, they represent capital injections that cannot reliably fund yearly obligations. Both perspectives stem from legitimate financial logic, yet they lead to sharply different conclusions about what constitutes a sustainable compensation model. The debate also highlights how modern sports leagues are valued not just on current earnings but on projected future potential. Investors often pay high prices because they believe a league will become more lucrative over time. That belief doesn't automatically translate into immediate cash flow, however. It reflects expectations rather than present-day profit. As fans attempt to parse these financial nuances, many find themselves unexpectedly immersed in lessons about sports economics. Concepts once discussed only among accountants and executives, valuation multiples, revenue streams, amortization, are now appearing in everyday fan conversations. The expansion fee argument has therefore become more than a bargaining detail, it has turned into a public crash course in how professional leagues actually make money.
League is coming from, given the attendance and viewership is primarily driven by a single player and team. They, again, the players started this cause, too soon. They should have given it one good year. They don't understand the concept that relocation fees, expansion, etc. is not reoccurring revenue. David Sampson had a great...
Stepping back, the broader picture reveals a negotiation shaped as much by narrative as by numbers. Labor talks in professional sports rarely unfold quietly, but this one has become especially visible because fans now have access to fragments of financial data, leaked proposals, and real-time commentary from analysts. Each new statistic or quote instantly fuels fresh debate, creating a cycle in which perception evolves almost hourly. For the players' union, the central challenge is rebuilding confidence among supporters who currently question its strategy. For ownership, the task is proving that caution stems from fiscal responsibility rather than reluctance to reward talent. Both sides must not only negotiate with each other but also communicate convincingly with the public, whose opinions can shape the environment in which deals are finalized. History shows that prolonged stalemates can carry risks for everyone involved. Delays may disrupt schedules, strain relationships, and dampen momentum gained from recent surges in interest. At the same time, rushed agreements reached under pressure can create problems later if terms prove unsustainable. Striking the right balance requires patience, clarity, and mutual trust, qualities that become harder to maintain once tensions escalate. What makes this moment particularly pivotal is that it arrives during a period of heightened attention for women's basketball. Visibility is rising, new audiences are tuning in, and commercial opportunities appear to be expanding. Decisions made now could influence whether that momentum accelerates or stalls. In that sense, the negotiation isn't just about percentages or salaries, it's about defining the league's economic blueprint for years to come. Ultimately, labor disputes tend to resolve not when one side wins outright but when both sides conclude that cooperation serves them better than conflict. Whether that realization comes soon or after prolonged negotiation remains uncertain. What is certain is that fans, analysts, and stakeholders will continue watching closely, aware that the outcome could shape the future direction of the sport itself.